This video is an Uncovered Japan company research report on Copro-Holdings, ticker 7059. Copro recruits, trains, and deploys the engineers and site managers behind Japan's construction projects. Its operating model is unusually strong, but a major acquisition has made the next stage of the story more complicated. At the report date, Copro combined a 31.8% return on equity with a roughly 6% dividend yield. The headline forward PE was 17.3 times, but the report estimates 7.3 times after adding back acquisition-related goodwill amortization. The catch is balance sheet risk. The Trite acquisition pushed the equity ratio down to 20.8%. Copro is not selling a physical product. It runs an engineer supply loop, recruit candidates, train them in-house, place them at customer sites, then provide follow-up and career support. The report identifies this integrated loop as the moat because direct recruiting and owned training expand the available labor pool while avoiding the agency fees that weigh on rivals. Copro construction is concentrated in site management work, but not in a single subcycle. Building construction represents 47.8% of the core mix, while civil engineering and plant work add exposure to infrastructure and industrial projects. Construction administration was the fastest growing pocket, rising 44.1% year-on-year, and potentially widening the addressable talent pool. The operating record is powerful. From fiscal 2022 to fiscal 2026, revenue rose from 15.6 billion yen to 36.7 billion yen, a 23.8% compound annual rate. Operating profit compounded at 22.4%. The underlying driver was a sharp expansion in engineer headcount, together with higher billing per engineer and the first contribution from Trite. The FY27 reported profit dip needs careful interpretation. The Trite transaction created roughly 27.7 billion yen of goodwill, amortized at about 2.18 billion yen per year under the current accounting treatment. That charge depresses GAAP profit, even as the report's pre-goodwill operating and EPS measures continue to rise. This is an accounting adjustment, not proof that the underlying staffing business has stopped growing. The group has one clear profit engine. Copro Construction, which accounts for about 85% of group revenue, earned a 15.7% operating margin in fiscal 2026. By contrast, the smaller mechatronics and semiconductor staffing business was loss-making. The core is excellent. The technology unit is an unresolved turnaround question, rather than a second engine today. This chart captures the central tension. Return on equity reached 31.8% in fiscal 2026. But the acquisition funding moved Copro from a fortress balance sheet to a highly leveraged snapshot. The roughly 29.2 billion yen bridge loan is intended to be refinanced into longer-term borrowing. Yet goodwill and integration performance now matter far more to shareholders than they did before the deal. Copro's asset-light model has converted growth into cash. Fiscal 2026 operating cash flow was 3.1 billion yen, and free cash flow excluding M&A was 2.4 billion yen, while routine capital expenditure has been low. That cash generation helps explain the dividend capacity, but it also needs to carry a more important job now: servicing and reducing the debt associated with Trite. Management's ambition is to reach 100 billion yen of revenue by fiscal 2030. The immediate step is integration. Copro's novice recruiting and training pipeline is meant to complement Trite's experienced hire recruiting and placement network. If those recruiting channels, training resources, and customer relationships reinforce one another, the acquisition can add scale. If retention or integration suffers, the goodwill becomes the main risk. Copro valuation is easy to misread. On GAAP forward earnings, the shares appear to trade at 17.3 times earnings. On the report's pre-goodwill measure, the multiple was closer to 7.3 times, below peers and below the company's historical average. That gap is potential upside only if investors gain confidence in integration, refinancing, and the planned accounting transition. To sum up, Copro is a number 2 construction engineer staffing company with a real recruiting and training advantage, strong recent growth, high returns, and meaningful dividend support. The same Trite deal that creates a larger opportunity also raises leverage, goodwill, and execution risk. The practical indicators to watch are engineer retention, integration synergies, debt refinancing, and the future IFRS transition. This is research, not investment advice. For a much deeper look, Visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.